Aside from this week's volatility, gold prices have remained under pressure and world gold demand lagged, especially last quarter, according to the World Gold Council's latest trends report. Joining us today to talk about the report is Juan Carlos Artigas of the Gold Council. Juan Carlos, thank you so much for being with us.
Thank you, Daniela. Thanks for having me.
So let's start by talking about the lower gold demand. It was down to a 6-year low, mainly due to the lagging appetite we saw coming out of China and India. Do you expect demand to pick up later this year?
Basically, we have to understand that the report that we put out was based on Q2, right? So that is talking about what happened in the past. In some sense, we've seen already that pan out. Our outlook is actually brighter than what happened. As you said, there was some weakness in both India and China for some reasons on consumer growth and income growth. But what we expect is demand to be boosted in part by the pullback in prices that we saw later in July.
Right, and not all the news was bad. Retail investment was up, especially in Europe and US. Do you expect this trend to continue?
That's very interesting because Europe saw an increase, as you said, both on the jewelry and especially on the investment side. I want to highlight a little bit or concentrate a little bit on that, in part because one of the issues for investors at the beginning of the year was that they felt that gold demand was not reacting in the way that it should when Greece and the Greece exit was in the forefront of newspapers. The fact of the matter is that actually for investors and consumers that was a systemic risk, in particular Europeans, that was indeed happening. So demand for gold was going up in Europe as they saw definitely an issue happening in Greece and the potential ramifications. It may not necessarily have been perceived in the same way for the rest of the world, but it was for Europe. Sorry, and then as you said, also in the US, you saw higher increase in jewelry demand as the economy continues to boost, which is important because you have to understand that gold has a dual nature, is consumption and investment. And the consumption side follows a pro-cyclical pattern. In other words, it increases with economic growth. And then the investment side tends to be more driven by uncertainty or when you have a flight to quality or a need for a high quality liquid asset such as gold.
Now, I really want to talk to you about China. They've been much more vocal in regards to their gold reserves. In fact, today they said their reserves went up again in the month of July from the month of June. But a lot of people question these numbers, saying that they should be higher. What do you make of them?
Well, there was an expectation by a part of the market that when China made the announcement, not today, but about a month or a few weeks ago, that they had increased their reserves by about 600 tons. There was a part of the market that was expecting a higher number. Some of them expected about 1,000 tons and some others even higher numbers. What we actually expected, and we published these about a year ago, was that when China announced its reserve, they would have increased by 500 plus tons or 500 and higher. So it was more or less in line with what we were expecting based on previous trends of Chinese announcements. However, the announcement today is quite interesting because basically they are announcing purchases in a month right after they had announced a collective purchase for about 5 or 6 years. So we are seeing these more as a move towards transparency and a way for the Chinese government to be signaling or highlighting their commitment towards an internationalization of the renminbi and the importance in our mind that gold has in foreign reserves to achieve something like this.
Well, they are definitely more transparent. Let's talk gold price now and gold supply. It was lower last quarter. This might be good news for the metal if this trend continues.
Well, gold supply actually as a whole has been declining for some time, while mine production was higher, and even last quarter it was slightly higher. Recycling has been coming down, and you have these two parts again to supply. You have mine production and you have recycling. And what we believe is that there are two things happening. First of all, while mine production was up and it has been going up for a bit, not much more than it was at the beginning of the decade, but it has been going up. We are expecting that to taper off within the next year or so, in part because of less exploration happening and other components or other variables affecting the mine production cycle. And on the other hand, you have recycling that has consistently been coming down since 2009. So, of course, gold and gold prices are going to be a byproduct of demand and supply, and that is something to keep in mind. So you do have pressure on the supply side.
So why is it taking so long to affect the price?
Well, you have two aspects of gold in terms of short-term price discovery and the long-term trends, and long-term trends are long-term trends, right? So you have to understand that there's going to be a little bit of back and forth in terms of where demand settled, where supply is going, but also what is happening on the short term that from the perspective of a long-term investor should be less important.
All right, finally, let's wrap with your thoughts on the gold price. It had a good week, but how do you see it for the rest of the year?
Well, we don't forecast the price of gold, but what I can tell you, though, is that this week really highlighted the importance of gold as a currency hedge and the fact that it's a global asset that is influenced by global factors, so you cannot, or investors should not only focus on one thing like the US or US rates, but really look at gold from a macro global perspective.
Juan Carlos, thank you so much for stopping by today.
Thank you so much for the invitation, Daniela.
And thank you for watching this Friday's Gold Report. We'll see you next week.